Good morning, everyone. This particular session would talk about the conceptual framework for financial reporting, which is basically the bedrock or foundation of all accounting standards that are applicable to certain transactions. So when we say bedrock or foundation, basically everything that is made in accounting, all policies, frameworks, specific rules, and standards are inspired and they do come from this conceptual framework. All right. So as you can see on your respective screen, there is the illustration showing a summary. I like this summary of conceptual framework for financial reporting, which basically illustrates to us guys the different levels. So we can see here on the first level, the objectives for the said framework. And by this, we can ask ourselves as to why is there a framework? And then on the second level, we have the second level and the bridge. The second level will talk about the qualitative characteristics. Then the bridge, meaning the connection between the first and second level to the third level and so on, would be the elements. So these are the accounting elements that we will know of specifically. But if you're again already done with a lot of accounting subjects, of course you know them, the accounting values or elements, namely assets, liabilities, your equity, income, and expenses. And finally, the third level, which would answer the how question. So these are the foundation principles and conventions. So these are now, for example, assets, what are the principles about them? All right. So I like this summary because it is very simplified. All right. So let's do now our discussions. Our discussions would be coming from our source, which is the book of Milan, but I will also be using other sources for discussions. All right, so let's begin with this. This is the first part of conceptual framework and accounting standards. Here are our learning objectives. We have to state, or as learners, you can state the purpose, status, and scope of the conceptual framework. What is its objective? So what is the status of meaning? What should be consider what should be prioritized and what are the boundaries or the limitations within. Next would be stating the objectives. You can state the objective of financial reporting. We can identify the primary users of FSS. We explain briefly the qualitative characteristics. What are these qualitative, meaning what are these characteristics that would make the information useful. It's qualitative because it is a descriptive, it's written in words, it's stated in words, and how they are applied in financial reporting. Next would be the accounting elements or values. We need to define them and what are their recognition criteria. So when do we include them in our records and later on to financial statements, and when do we remove them or how to remove them? Then finally, we have to state or describe or define the measurement basis used in financial reporting. So what are these values or amounts that we can see on the financial statements? But I guess I've discussed this somewhere already in the overview of accounting. All right. So purpose of the conceptual framework basically, or the purposes for general purpose financial reporting would be three. As what I've said in overview of accounting, that the reports that we can produce or prepare in financial statements preparation and presentation would be general purpose. So it would answer or respond to the common needs of wide range of users. So it would not address the specific needs of them. So here are the three purposes. It would assist the IASB in developing standards that are based on consistent concepts. The IASB, as what I've said, is the board that is based in London, United Kingdom, that is in charge in the development of accounting standards. These accounting standards are to be used by businesses and the accountants and auditors in the field to apply for certain transactions. The concepts are consistent. meaning they are connected with each other. They are to be applied on consistent basis, meaning uniform basis, unless meaningful changes should be applied. Next, there will be assist preparers. This is now on the part of the management and the accountants in the field of business in developing consistent accounting policies when no standard applies to a particular transaction or when a standard allows a choice of accounting policy. Now, as being discussed or will be discussed later on in the hierarchy of the application of the standards and conceptual framework, we will know that the standards specifically for transactions should be applied because they talk to them specifically, they discuss, they prescribe some actions and computations, disclosure requirements there. However, if there are no accounting standards, this would mean that we have to follow the bedrock or foundation, which is the conceptual framework, and or when a standard allows a choice of accounting policy. So if we are given the freedom to do what needs to be done, then we can also make use of the conceptual framework. Letter C, this would also assist all parties in understanding and interpreting the standards. So the all parties here are also the users of financial reports or statements aside from the ISB and the preparers or management, including the investors or shareholders, for example. So how can they understand the standards or interpret them? Then they can go to the conceptual framework for guidance. All right, that's the purpose. After that is the status. We have to know that if we are looking again for specific standards that would be applicable to certain transactions, we have to go to the PFRSS, the specific Philippine Financial Reporting Standards, which are based to international financial reporting standards. However, if they're not available, then we have to use the conceptual framework. This is again the topic that we're discussing now, which is our basis. And then we have to take note that in the event that there is conflict between the conceptual framework and the PFRS, it simply follows that the PFRS will prevail or should be followed. Then, what about if no accounting standard is available? Actually, the hierarchy would tell us that on top would be the specific PFRS that is applicable to that transaction. If not available, then we have to look into other specific PFRSs that would talk or that mentioned such transaction or similar types of transactions, and we will be guided accordingly. In that absence, then we can go now, in the absence of the two, go to the conceptual framework in making judgment and developing and applying an accounting policy that results in useful information. So this is the time now that management becomes creative in a sense, but still guided by the conceptual framework. Next, what are the components of the conceptual framework? If we say the scope, then we talk about 8 items here. So again, the conceptual framework would talk about preparation of the so-called general purpose financial statements. So here are the following items under the conceptual framework. So we can see here the objective of financial reporting, qualitative characteristics, the financial statements, including the reporting entity, the elements of financial statements, recognition and the recognition, measurement, presentation and disclosure, and the concepts of capital and capital maintenance. So these are the specific concepts that we are going to talk about. For the first part, I would stop under, let's see, probably in number 4, the elements of financial statements, meaning halfway of the list. All right, to continue. So what is the objective of financial reporting for general purpose? This is to provide financial information about the reporting entity that is useful to primary users in making decisions about providing resources to the entity. So we have already said that in this particular case, the financial reporting actually would really provide the reports in the form of financial statements. These reports contain financial information, or the financial statements contain information that basically are quantitative, primarily financial in nature, about the reporting entity. This particular information is useful to users of financial statements in making wise economic decisions, because they provide basically resources to the entity or business that prepares the financial statements. So it's just give and take, in other words. So you give resources to us, so we provide the reports to you so that you can make decisions which are wise and relevant and useful and meaningful later on. All right. The objective serves as or forms the foundation of the conceptual framework. Because of the first statement here, which is very aptly and simply made, like it captures everything, or simply it gets the general purpose financial reporting. So this forms as the foundation or bedrock of the conceptual framework. Then primary users are those who cannot demand information directly from reporting entities. Basically, they cannot go there to the office of the business and then they would be asking or demanding reports from the management. They cannot do that. Examples are existing and potential investors who will provide capital or funds or resources to the business, as well as the lenders and other creditors, which are the liability claimants, or they have the claims to the resources of the business. For letter A, they are equity holders. They provide resources in the form of shares, for example, for the corporation or stocks. But letter B, they're also holders, but for the liabilities. So they have claims to the assets, meaning they can collect assets later on from the business. We also have to take note that only the common needs of primary users are met by the financial statements, hence the very essence of general purpose. It cannot answer all needs of users or primary users, only the common needs. Or let's say the users have different needs, but we will just be answering or responding to what's similar or common to them. All right. After that, here are the qualitative characteristics. So this is a good summary of the qualitative characteristics, which would focus on the fundamental and the enhancing. So we have to take note that the fundamental, meaning the basic, would be the essence really of a quality report or information. But the enhancing would add value to the fundamentals. That's the point. The fundamental would be talking about relevance and faithful representation. Then relevance, you have predictive and feedback value. Materiality is under feedback. For faithful representation, you have completeness, neutrality, and free from error. For enhancing, you have CVTU, but I will be using the acronym VCUT. Verifiability, comparability, understandability, and timeliness. So these are the four enhancing qualitative characteristics. All right. The fundamental would make information useful to users, and enhancing would enhance, meaning would add value to the usefulness of that information. So in other words, we cannot have just enhancing alone. Otherwise, if we do not satisfy the fundamentals, then enhancing would be useless, because fundamentals should be there to be useful. All right. So what I mean by that is, for example, if it is not relevant, even if we have enhancing, that information really is not useful because it does not satisfy the fundamental, which is relevant. And it should be all of them, not just one or two or majority. It should be all. Right. Then after that, this is for fundamentals. Under fundamentals would be relevance. For the relevance, it would affect the decisions of users. So it will basically make difference as to the decision of the users. If the user is well aware of this particular information, then he or she will be making this decision. But if not, the decision would be different, and that is relevance. Then relevance has the following items under predictive and confirmatory. Predictive would mean that it can be used as a basis of predictions. So the information gathered can be used to estimate or predict what can happen in the future time. Whereas confirmatory would be able to confirm or verify the past prediction. And confirmatory is also known as feedback value because by feedback we get that, oh, we were right with the prediction or we were wrong. Then materiality is being discussed here. It is subjective in nature. It is a case-to-case basis, although we can be objective, but then overall, it depends upon the nature of the item, its size, the quantitative as well as the qualitative factors. So one entity may view one item as material, the other won't. All right, that's for relevance. Another one is faithful representation. For faithful representation, or for some would call this one representational faithfulness, which is just the reverse, but we will be using faithful representation anyway. It means that the information that would really make the decision making of the users wise and thoughtful would be there, would be present, complete, they are accurate, correct, and unbiased. All right, so true, correct, and complete depiction of what it purports to represent. What should be presented is there, faithfully. To be faithful, we have the following characteristics. Completeness would mean that all information necessary so that users can understand is there, provided. Neutrality is that there's no bias. There is no such thing as partial, right? Partiality of information, or meaning the information is already having, let's just say, a subconscious decision, right? Or a cooked already decision, some would say that. Then finally is free from error. What is meant here is that errors which are material are not there because whether we like it or not, nothing is perfect. We know that also, but we have to keep the errors as much as possible to the very least or minimum or very minimal levels so that they would not be material. As what I've said, material would mean that it would affect also the decision making of the users. So the omission or inclusion or misstatement, meaning wrong information, can have impact on the decision making. That's materiality. So free from material errors, we can of course say that. That's for faithful representation. All right, now after the fundamentals, we have the enhancements. So the enhancing qualitative characteristics. Now guys, qualitative again because these are expressed in words and descriptions as opposed to quantitative, which means numbers or figures, numerical figures or amounts. We have the following, so VCUT would be our acronym. Anyway, I'll begin with verifiability, which means that if there are different users, they could reach a common decision or agreement or consensus as to what the information purports to represent. If we have a lot of users and they are being given this particular information, they would really achieve common decision or common outcome or common agreement as to the information that should be derived at. All right. Next is comparability. In comparability, we would be able to look for the similarities, so the same items or aspects, and also the differences. So what are the same items and what are the differences in different sets of information. So we can see the relationships and whatnot. On the other hand, we also have understandability. So in understandability, the information presented is readable. It can help the users to have wise economic decision making. I kept on saying wise because that is a concept in economics. As rational users or being, then the information that we should be getting should be something that would add value to our lives or our economic decisions. Now, for understandability, then users are expected to have. In as much as we want to provide information, by the way, to them, which would be meaningful and understandable and readable to them. However, we also have the expectations from users that they have the reasonable knowledge of business activities. So they understand business, they know the terms, they know the transactions and all. However, if they do not know, which is also something that we can anticipate about, they are willing to analyze the information diligently. So they can look for sources, they are willing to study, research, conduct in-depth investigation if needed, so that they would be able to analyze the information diligently and well later on. And finally, that's timeliness. So completing the VCUT for enhancements, wherein the information is available to our users in time so that they would be able to influence their decision. So the information is available as soon as it is needed by the respective users. However, again, there is the so-called timeliness versus accuracy constraint that sometimes because we are focused with how accurate the information is, that's why we cannot provide it on time that it is needed, which is defeating the purpose of the report. So that's why we are giving the allowance for errors which are immaterial, right? So we would accept immaterial errors, but not the material errors, because even if there are errors or estimates, we have to be timely in giving the information as soon as it is needed. Next, for financial statements and the reporting entity, so we have here the objective and scope of financial statements. So objective again is basically we have to provide the financial information. So anything that talks about money, about the reporting entities, accounting elements or values from assets down to expenses that is useful in assessing number one or letter A. That is if that entity can generate future net cash inflows. So as much as possible, we want that the information that we will provide would show that the entity can still obtain cash inflows. So positive, meaning the inflows minus the outflows equals still positive amount in the future time. We want that to happen to the business. And also the reports would show how the management makes use of the economic resources because they are stewards, they are guardians, or they are safe keepers of the economic resources or assets of the business. So how well they use the assets of the business. That's stewardship. For the reporting period, as much as possible, we have at least once a year time period under periodicity concept as discussed in overview to prepare the reports for our users or the clientele or clients. However, we also know that there are so-called interim periods wherein there are periods or accounting periods of less than 1 year. So namely, we have monthly every month, quarterly every 3 months, and semi-annually or semestral every 6 months or half a year. That's twice a year. And this would include comparative information, which is something that is needed in preparing reports. So if we say annual, so it should be having a comparison of 1 year prior. So if we have 2019 financial statements, it should have a comparison of 2018 financial statements. That's reporting period. Next one is going concern. For going concern, we have here the assumption that the entity would continue for a foreseeable future time, for an indefinite period of time, and for a foreseeable future time. So the business would continue up to the time that the owners or the management would decide to end its affairs. And that's why the concern is called going concern, or it's also called continuity assumption. Some would say that going concern would be the business will operate for beyond the horizon, so beyond what we can see, because it's going to be in a future time. We can think of it, but we don't know what can happen. In addition, these things are discussed already in overview of accounting as well as in fundamentals of accounting for the so-called underlying assumptions or accounting assumptions that we have known of. Periodicity concept for this one, the time period assumption, and continuity assumption or going concern. To continue, we have the reporting entity, that is the entity that is required to prepare financial statements. It may not be a legal entity. In accounting, we assume that the reporting entity is more on economic substance than the legal form. And that's why even the so-called combined entities or consolidated entities like the parent and its affiliates or sister companies would combine their financial statements or consolidate them, and they will be required to prepare one, although it may not be a legal entity to begin with. All right. So before we continue to elements, it should be known though that the reporting entity is based also on the so-called entity concept, wherein the entity is a distinct and separate person from its owners. Also, economic substance over legal form, or simply substance over form, wherein we look into the substance of a transaction than the legal form. Because for all we know, an entity is required to report, as I've said, the combined or consolidated entity between the parent and its group, branches, subsidiaries, or affiliates, the members of the group's sister companies, brother companies, and etc. and the likes will be preparing the financial statements as a whole, but there is no like legally filed entity with a SEC, Securities and Exchange Commission. So that's the concept of reporting entity. And aside from that, legal matters or the law is not synonymous to accounting. Accounting is for the business, for the financial statements preparation and presentation. Law is another field or discipline. Next, elements of financial statements, as what I've said, are also known as accounting values. And these are from assets to expenses. The first three are found on the entity's statement of financial position, which would measure the financial position of the business. So the financial position would be as of that particular time, what is the standing of the business? Is it growing? Is it not? Or at what stage we are in? That's it. Then we would know the resources owned by the business, what are the financial obligations, and what's left after we deduct liabilities from assets. So these three would measure the financial position. The financial performance would be talking about income and expenses, and the difference would be profit or loss. Profit if income exceeds expenses, and loss if the reverse. So that would be the performance, also known as the bottom line, or the profit or loss, or the net income or net loss, or also known as the performance indicator. So there can be many terms talking about the profit or loss, the difference of the two. And the first three is found in the statement of financial position, formerly known as balance sheet, while the fourth and the fifth one, these are found on the statement of comprehensive income, formerly known as income statement. All right. So here are now the accounting elements being discussed. Asset, as what I've said, is any resource owned by the business. Ownership means control of that particular asset, and control may not necessarily mean possession. So possession meaning the asset is in the hands or on the hands of the business physically. It may be that it is physically used by another, but it is still owned by the business because control is there. Control because the owner can create a right or stop the right, can create the right to use of the asset or stop the usage of the asset. And it is coming from past events. Accounting is normally recording of past transactions or events. Then economic resource is more on the right of the asset to control or produce or consume the economic benefits than the physical ownership or the physical possession of the asset. It's more on the right to control the benefits over the asset, which is now a revision under the conceptual framework revised in 2018. Next, what are the three aspects in the definition of an asset? So as what I've said, it's more on the right, not the physical object. So if we have the right to use it, sell, lease is another word for rent or transfer a building. Next one is the potential to produce economic benefits. So we can make use of the assets so that we would have revenues, we can have more benefits or economic benefits and the gross inflows of them. Then such potential need not be certain or even likely. What is important is that the right already exists and that in at least one circumstance, it would produce economic benefits for the entity. So this is clear. It's not necessarily like all the time, at least one situation that it would provide benefits. Control is that, again, we have the right to create the right for another entity to make use of the asset or produce benefits, or we have the right to stop it. And that's an exclusive right to access the benefits or to prevent others from accessing those benefits. All right, that's the three aspects. On the other hand, we also have the liability, which means the present obligation or financial obligation of the entity to transfer an economic resource to let go or shift that resource as a result of past events. So as you can see, it's again about past events, present obligation though, and that obligation can be coming from law, legal, or constructive from the practice of the business endeavors, just like warranty. So warranty normally is given after sale of transactions. It may be implied in the situation. All right, that's for liability. Here we have the three aspects in the liability. There is an obligation, which it is a duty or responsibility, which is financial in nature, of course, that has no practical ability to avoid, meaning we cannot escape it as much as possible, so it has to be paid. Second is transfer of an economic resource in order to settle or pay the liability. To pay it, we need to transfer another resource, normally, let's say cash or non-cash assets, or it's also possible to change this away higher, but we can also settle liability by settling it with another one. For example, if there is, let's say, an accounts payable, if we order goods or if we buy goods on account, we did not pay cash yet, just an oral or verbal promise to pay in a future time, that is accounts payable. But if we, for example, issue now a promissory note, so there would be a transfer from accounts payable to notes payable. And that is a transfer of economic resource in a way that is from liability settling with another liability, or a liability can also be settled with an equity. So that's also another situation or case. But as much as possible or as usual in terms, it would be an asset or another asset. Could be cash or non-cash. Or monetary, meaning in money terms, or non-monetary. That's second one. The third one is it's a present obligation. We see that there's an obligation now because of a certain past event. So we have already obtained the economic benefits or taken the action, or as a consequence, the entity will or may have to transfer an economic resource that it would not otherwise have had to transfer. So meaning if we entered into this particular transaction, then we have to pay this particular amount and certain asset to do that. But if we did not enter, then we would not have recorded an obligation. So that's the point of letter B as a consequence of A. All right, so there's also a mention of the so-called executory contracts, wherein executory contracts are not yet 100% fulfilled. So it's possible that neither party has fulfilled, or there is just partial fulfillment by one and not both, not including the other. So it is equally unperformed. Therefore, an executory contract is going to have something, some rules to follow. Anyway, definition: an executory contract establishes a combined right and obligation to exchange economic resources. So it's going to be two-way, so vice versa, just like a sale transaction that one has to pay to buy an asset and the other has to let go of the money to buy the asset. Then the other also would be paying money to have the asset, while the other has to let go of the inventory or the product to sell. So that's contract of sale. The contract ceases to be executory, meaning it stops when one party performs its obligation. Example, if the entity performs first, the entity's combined rights and obligation changes to an asset. So if one party, for example, pays, then there is really the right to receive that particular asset that is to be acquired. If the other party performs first, so meaning, let's say the party delivers or sells the asset to you, but you did not pay yet, there is now an obligation on one end to pay in a future time. So in other words, this analysis is on the part of the buyer of the product. Although if we are going to analyze, there are two parties, the buyer and the seller, but to simplify, we are on the buyer's side. And we can say that if the buyer pays, there's prepayment, so that's an asset. If the buyer did not pay yet but receives the asset in advance, that's a liability or obligation to pay in a future time. So that's the essence of executory contracts. Next, equity. Equity is the residual interest. Residual meaning this is what is left after we deduct liabilities from assets. From the word residue, meaning the remainder or the residue or what is left after. Then assets minus liabilities equals equity. So this is based on the basic accounting equation: assets equals liabilities plus equity. So if we just have to transfer liabilities minus the assets, so we will get the equity. Now, income and expenses, on the other hand, are the opposites. If income are increases in assets, expenses are the decreases. If income would be the decreases in liabilities, then expenses would be the increases. So we can just see here that income or equity is synonymous. I said equity because I mean income is really connected with the equity. So income is a plus to the equity. So that's why we will realize as we go along the way, although this is not discussed here, but in the analysis of transactions and rules of debit and credit, but I'm just saying that income and equity would be synonymous and would be, of course, in that way I said synonymous because they have the same impact to equity or to assets and vice versa. So anyway, income really is different from equity based on definition alone. We can see that. But my point is that income and equity would be having direct relationship with the assets. So we can say that when one increases, or the two, income and equity, the other also increases and vice versa. But they have inverse or indirect relationship with liabilities. So if you can see income increases as well as the equity, the liabilities would decrease. And the opposite would happen to expenses. So expenses have inverse relationship with assets, but direct relationship with liabilities. Let's go back to income. Income also would mean the gross inflows of economic benefits. So benefits can exist in many forms. Could be quantitative in numbers, could be qualitative in words. If quantitative, could be financial, meaning numbers, but in pesos or any other currencies or money, or non-financial, meaning in any number except money. And then that would be a plus. So if plus to economic benefits or income, that would also increase the equity. So that's what I said. Income and equity have direct relationship to assets, but inverse to liabilities. But with the exception of contributions from holders of equity claims. These are the investments, whether initial or additional, of the equity holders or the owner or owners. Could be partners of a partnership, could be owner of a sole proprietorship, could be shareholders or stockholders for corporations, and members for cooperatives. Then for expenses, expenses would be the decreases in equity, because when expenses would increase, so the equity would decrease. If expenses now are close to the equity account later on, if we follow the steps of closing process or processes, then liabilities would increase, so equity would decrease, other than those distributions to holders of equity claims. These are the drawings or withdrawals of the owners and the partners, or owner and partners. Then the dividends of the shareholders or stockholders and the members of the four forms of business organizations, respectively. So proprietorship, partnership, corporation, and cooperative. So these are the two discussions for the latter two income and expenses accounting elements. All right, so the next step would be recognition and the recognition, which would be tackled in the second half of this session. So stay tuned and see you next time for another session for conceptual framework for financial reporting. Thank you and God bless.